What's up, Jill? It's Guy here. How do you avoid capital gains tax when selling your home? Well, let's break it down. Capital gains tax is what you owe the taxman when you sell your home for more than you bought it for. The difference between the purchase price and the sale price is your capital gain, and that's what's subject to tax. Now, there's a twist. Capital gains tax rates vary depending on how long you've owned your home. If you sell within a year of buying, you're looking at short-term rates, which are the same as your ordinary income tax rate, and could be as high as 37% for higher income individuals. If you hold onto your home for over a year before selling, long-term rates apply. These range from 0 to 20% based on your income and filing status. But don't worry, there are ways to avoid this tax altogether. The IRS provides some key rules to exclude capital gains tax. To be eligible for this tax exemption, the home must be your principal residence, meaning you've lived in it for at least 2 years out of the last 5. Now, if you're single and meet these requirements, you can exclude up to $250,000 of the gain from your capital gains tax. For married couples filing jointly, this exclusion doubles to $500,000. Interestingly, even a rental property can become your principal residence over time, thanks to the flexible nature of the 2-year residency requirement. It's not necessary for these 24 months to be consecutive. But remember, when it comes to multiple homes, the IRS only allows the exclusion on one primary residence. So understanding which home to designate as your principal residence becomes crucial to reap the benefits of these exclusions. So how do we calculate the capital gains tax, and what happens if we exceed the exclusion limit? First, you need to determine your profit, which is the selling price of your home minus the cost to acquire and improve it. This gives you your capital gain. Now, capital gains tax rates can vary. If your income is between $44,626 and $492,300, for example, you could be looking at a 15% tax on your gains. Now, let's talk about exceeding the exclusion limit. If your profit surpasses the $250,000 for single filers or $500,000 for joint filers, the excess is subject to capital gains tax. But remember, to qualify for these exclusions, you need to meet the Internal Revenue Service's ownership and use criteria. But don't fret if your profits exceed the exclusion amount. There are still ways to minimize your tax liability. Now let's explore ways to minimize or even completely avoid capital gains tax. First, consider offsetting gains with losses from other investments. This strategy, often called tax loss harvesting, involves selling investments that have lost value to offset the gains from the sale of your home. Next, you can adjust your cost basis to lower your gain. Your cost basis is essentially what you paid for the home, but it can also include improvements that add to the home's value. Examples that increase the cost basis includes bathroom or kitchen upgrades, home additions, new roofing, the addition of a fence, and various landscaping enhancements. By increasing your cost basis, you effectively decrease your capital gain, which could lower your capital gains tax. Lastly, you might consider converting a second home into your principal residence. By meeting the IRS's residency requirements, this home could then qualify for the capital gains tax exclusion. Remember, with careful planning and understanding of the IRS rules, you can avoid or minimize capital gains tax when selling your home. Remember, I'm not a tax professional or any other professional. I'm just a guy on YouTube.